Can Broadcom turn its $11 billion Anthropic deal into massive growth? You know what's fascinating about financial markets? They're kind of like a theater, filled with drama, suspense, and a cast of players whose every move can set off waves of emotion across the investing world. And this week, one of the biggest performances came from none other than Broadcom Incorporated, a tech giant that rode high on the artificial intelligence wave until it hit a little turbulence. Welcome to Impact Solutions Podcast, where we break down business stories that shape tomorrow's markets without the jargon or the noise. I'm glad you're here because today's episode is a perfect example of how expectation can be both a company's biggest ally and its most dangerous test. So let's set the stage. Broadcom, ticker symbol Broadcom, has been one of those shining stars of 2025, powered by the ongoing AI rush. Investors have latched onto anything with the letters A and I in it, and Broadcom had all the right credentials: custom chips, strong partnerships, and a massive presence in data infrastructure. Its stock had been soaring, and for good reason. But when a company's story becomes part of an investing frenzy, the bar for success rises almost absurdly high. That's what we saw unfold over the last 24 hours. Broadcom's CEO, Hock Tan, got on an earnings call that was meant to be a celebration. After all, the company had beaten Wall Street's expectations with projected first-quarter sales of about $19.1 billion. Analysts were predicting $18.5 billion, so naturally, that's an impressive beat by any measure. On top of that, Broadcom announced a 10% dividend hike to 65 cents a share, sending a clear signal that the leadership felt confident about the company's cash flow and near-term prospects. But then came the part that turned the party into a bit of a reality check. Tam revealed that Broadcom had a backlog of $73 billion worth of AI product orders to be shipped over the next 6 quarters. Now, you might think that sounds huge, and it is. But here's the thing. Investors had been expecting something even higher. The number came across as underwhelming, and that disappointment rippled almost instantly. In after-hours trading, Broadcom's shares fell more than 5%, erasing earlier gains. And that right there tells you everything about the psychology of markets. It's not just about growth. It's about growing faster than the story investors already believe in. Hock Tan tried to clarify. He emphasized that the $73 billion figure was a minimum, meaning Broadcom anticipates more orders to come in over the next 6 quarters. He also explained that lead times, essentially the time between receiving an order and delivering it, can range anywhere from 6 months to a year, depending on the product. But the initial shock had already done its work. The market had expected fireworks. Instead, it got a modest celebration. And in an environment where AI-driven growth stocks are the darlings of the exchange, modest doesn't cut it. Now, let's pause here for a second and unpack why this reaction happened. From a business fundamentals perspective, Broadcom's numbers are solid, arguably even strong. But we're living in a market where the narrative often overshadows the reality. When NVIDIA reports blowout results and tech companies talk in terms of tripling AI demand, investors start to see every player through that same lens. So, even if a company like Broadcom posts an excellent backlog, it gets measured against a fantasy benchmark, one built on investor imagination rather than operational capacity. To make matters more interesting, Broadcom's CEO pointed out that AI products are actually compressing the company's overall profit margins. That's surprising to some because the general perception is that AI-related products command premium pricing. But Broadcom's business is different from a pure-play AI firm like NVIDIA. It's not only about GPUs or machine learning chips. Broadcom builds a lot of custom silicon, networking components, and integrated chips designed for very specific data center applications. And while demand is skyrocketing, the production costs and R&D needed to sustain that demand eat into margins. So what we're seeing is a fascinating push and pull. Huge incoming orders paired with tightening profit spreads. That's a tension investors have to understand when evaluating the long-term sustainability of Broadcom's growth story. Now, here's where the story gets even more compelling. Broadcom's top-line AI business wasn't just built on 1 or 2 clients. In fact, during the call, Tan mentioned an $11 billion order from Anthropic. Yes, That Anthropic, one of the leading AI startups competing with OpenAI and backed by giants like Amazon and Google. This followed a $10 billion deal the company signed in the previous quarter. So in just 2 quarters, that's over $21 billion in AI-related orders from just one client vertical. On top of that, there was another $1 billion order from a mystery customer. Tan didn't name them, but it's likely another major player in the AI infrastructure space. So, when you hear numbers like that, it's tempting to say, wait, what's everyone complaining about? It's because the markets have entered a phase where impressive is the new average. When everyone expects exponential growth, even strong performance feels flat. Let's think about the bigger implications. The entire semiconductor ecosystem is going through a massive structural shift. NVIDIA dominates the GPU landscape. AMD's clawing at the edges with high-performance alternatives. And then you have players like Broadcom, who occupy a different but equally critical niche. They provide the backbone, the custom silicon and networking architecture that actually allows data centers to run AI workloads at scale. Broadcom's strength lies not in making the flashiest chips, but in quietly owning the plumbing of the digital world. Every time your favorite AI model runs in a cloud data center, there's a good chance some part of that process travels through Broadcom's components. It's a behind-the-scenes role, but an essential one. However, here's the challenge. When you're the plumber, you rely heavily on your biggest customers, the big cloud providers, hyperscalers, and AI labs, to dictate the scale and timing of orders. If those customers slow down spending or focus on optimizing what they already have, your revenue rhythm fluctuates. And that's partly what we're beginning to see across the chip sector. The AI gold rush is real, but it's also cyclical. Waves of demand surge as new training models emerge, then slow as companies consolidate infrastructure. So Broadcom's story isn't about missing expectations per se. It's about navigating investor impatience while building an AI business that's more steady than spectacular. And honestly, that's Hock Tan's style. If you followed him for any length of time, you know he's known for being disciplined, almost understated. He doesn't hype, he executes. He built Broadcom into a tech powerhouse by integrating acquisitions like VMware, maintaining tight operational control, and focusing on profitability even when others chased growth for growth's sake. So, when Tan says minimum $73 billion, it's probably a conservative floor rather than a flashy ceiling. Now, let's analyze what this means for the broader tech market. The biggest story across 2024 and into 2025 has been capital rotation. Investors flowing money into AI-heavy infrastructure firms that can show long-term scalability. But we're now seeing early signs of maturity. NVIDIA's incredible performance set a pace few can match. Meanwhile, companies like Broadcom and AMD are adjusting to the idea that not every quarter can be a moonshot. And that recalibration is healthy. It separates sustainable business models from hype cycles. The market, of course, doesn't always see it that way. Stocks drop when growth doesn't accelerate fast enough, even if that slowdown is perfectly natural. For long-term investors, though, this is when opportunities arise. A company like Broadcom, with a proven earnings profile and consistent dividend growth, might actually look more appealing after a 5% dip than it did a week ago. Think about it this way. AI demand will continue to expand, but the market's curve is flattening from explosive to strategic. That means industry players who can manage costs, maintain margin discipline, and secure deep relationships with leading AI developers will win in the long run. Broadcom checks those boxes. And let's not forget that while the media focus is all on the AI backlog, Broadcom's business is far more diversified. Between broadband and networking segments, radio frequency components for mobile devices, and its massive software portfolio through VMware, Broadcom is positioning itself as not just a chip designer, but a full-stack tech supplier. That's a playbook we've seen before. Think of Apple's ecosystem strategy or Amazon's vertical dominance. It's about being everywhere in the value chain, not just in the hottest product line. Another angle worth noting is the cash management story. The 10% dividend increase tells us Tan and his team are confident in their liquidity and future cash flow. You don't raise dividends when you're unsure about your earnings base. So while investors may fret about AI margins, The board's decision suggests internal confidence about profitability resilience. Now, I want to zoom out even more. If we step back, what we're witnessing with Broadcom is a miniature version of the entire economy of expectations. In the stock market today, beating projections isn't enough. You have to beat the narrative. It's like running a marathon while spectators keep moving the finish line. And that's the paradox of success. The higher you climb, the narrower the margin of error becomes. The other point of discussion here is valuation. Broadcom's price-to-earnings multiple, even after the drop, remains lofty compared to historical norms. Investors paying those premiums are doing so under the assumption that AI-driven revenue acceleration will continue relentlessly. But as Tan warned, even with massive backlogs, margins may narrow. That means the pace of profit growth might not match the pace of revenue growth, a nuance that can make or break valuation comfort. So, investors will need to adjust their lens, focusing on operational efficiency and ecosystem strength rather than just top-line excitement. And frankly, that's where Broadcom shines. Over the years, Tan's steady approach has built a reputation for delivering on integration, maintaining high free cash flow, and steering clear of reckless expansion. That kind of discipline often doesn't grab headlines, but it creates durable shareholder value. Still, perception matters. In today's hyper-connected markets, real-time reactions amplify every comment, every forecast. Investors listen to an earnings call, pull out one number, in this case, $73 billion, and trade instantly. We're living in an era of micro-reactions, where every pause in a CEO's sentence can move billions. That's both fascinating and absurd, right? But it's the reality of modern finance. From a strategic standpoint, Broadcom is hedging its growth bets across multiple fronts: data centers, networking, software, and custom silicon. That kind of diversification may actually help it withstand AI market corrections better than more concentrated players. Now, what's next? Over the next 6 quarters, Broadcom will be under close watch to see how that backlog evolves. If the minimum number rises and shipments scale smoothly, investor confidence could rebound quickly. But if order growth slows or margins compress further, the stock might enter a consolidation phase. Either way, the company's operational execution will now matter more than the story around it. For the AI ecosystem as a whole, this is a healthy reality check. It reminds everyone, from startups to trillion-dollar giants, that scalability comes with trade-offs. You can have massive backlog growth, but if your profitability doesn't keep up, your valuation gravity eventually kicks in. Personally, I think Tan's comments were both measured and realistic. He's not trying to oversell a dream, he's building a foundation. And investors who value stability over spectacle might find that refreshing. At the same time, the reaction tells us how rattled markets are by any hint of slowing optimism. It's like a pendulum swinging between euphoria and anxiety, with logic barely hanging on in the middle. So as we wrap up today, here's what I'll leave you with. The next phase of the AI economy won't just reward companies that grow the fastest. It'll reward those that grow the smartest. The firms that can balance innovation, customer relationships, and financial discipline will be the ones still standing when the hype fades. And Broadcom might just be quietly proving that steady can win the marathon, even if the crowd is still cheering for the sprinters. So now, let me throw the question over to you. And this one's worth thinking about. In a world obsessed with exponential growth, do you think investors are overlooking the value of steady, margin-conscious execution? Or is Broadcom's slowdown a warning sign that the AI industry's momentum is cooling faster than we think? Drop your thoughts in the comments. I'd love to hear how you see it.